The Fed finally announced their rate cut, and it was a full 0.5%. But mortgage rates actually went up a little after they announced it. We'll discuss why in a minute. Mortgage rates are still lower than they've been any time in the last year, and it's causing a lot of good things to happen across the board. Here are a few. Mortgage purchase applications saw another big increase this week, and for the first time all year, we're back to the same level of mortgage demand that we had last year. For the first time in a year. So this is a big deal. Home buyers are enjoying these low rates. Then on the listing side, the trend is continuing that when mortgage rates drop, more people are going to list their home. Now, what's interesting is mortgage rates didn't even drop this time, but the perception that the market has is that if the Fed cuts rate, that means lower mortgage rates, which it doesn't, and we'll cover that. But just that perception of the Fed cutting rates led a lot of people to jump to list their house because they believe the Fed cutting rates is going to bring more buyers in. And really, most people don't understand the correlation between mortgage rates and the federal funds rate, so I'm going to explain that very clearly for you here in this week's market news. But as a result of this perception, we saw a huge jump in new listings this week, as well as overall inventory. So it's no surprise that lower rates are going to bring in more listings and more buyers. But the good news is, so far, even with the increased buyer demand, inventory is climbing to meet that demand, which is very important because it means prices aren't going to go through the roof as long as that trend continues. But what's unusual about all of this is normally this is the time of year when the market is slowing down. So we're just going to have to wait and see how long the hype from these lower mortgage rates will last and how low they'll actually get as we head into the final months of the year. So we're covering all of this and more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price cuts, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin County. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is September 23rd. Let's see what the data is telling us. And if this is an old video, you can click the playlist here to get to the latest weekly market update. Okay, first up is market news. Why did mortgage rates go up a little after the Fed announced their rate cut? Shouldn't it be the other way around? Well, if you've been watching my videos for a while, then you already know this, but the answer is the bond market. So I'm about to walk you through how mortgage rates actually work in relation to the federal funds rate, and then explain what it would take moving forward to see even lower mortgage rates. It's a lot of information, but I promise it's well worth it to take the time to understand how this all works. So first of all, the bond market is the one who actually sets the mortgage rates, not the Fed. Think of the federal funds rate as just a baseline that everyone is working off of. That funds rate helps the bond market determine the 10-year treasury yield. This 10-year treasury yield changes every day based on the implied risk at the time and the certainty or uncertainty of the financial markets and the economy. If they feel the economy is looking risky moving forward, then you may see a flight of people selling other investments and moving into bonds, which are perceived to be the safest investment instrument. So they want to take risk off the table, they might do a flight to safety into bonds. But if a lot of people flood to buy bonds all at once, the yield of the 10-year is going to go down as there are more buyers than sellers. Then the same is true in the opposite direction. If people are rushing to sell their low-yielding bonds to buy something they believe has a better return, then the 10-year yield will go up. Then as the yield goes up enough, it starts becoming attractive to buyers again, and that drives the yield back down. So we have this seesaw effect just like any other market anywhere that you've ever seen. We're constantly going up and down on the 10-year based on supply and demand. So we have the federal funds rate as the baseline, then we have bond auctions constantly moving the 10-year up and down on top of the baseline. Then the third component would be the spreads. When I say the spreads, I'm talking about the difference between the 10-year treasury yield and mortgage rates. So if the 10-year is at 5% and mortgage rates are at 7%, then you have a 2% spread. That's the 5% 10-year plus the 2% spread equals a 7% mortgage rate. And the spreads, just like the 10-year, fluctuate up and down based on the perceived certainty or uncertainty of the market. So let's take a look at this chart. This chart is just tracking the spreads. This is the 10-year versus mortgage rates. So do you remember a year ago when all the banks were going to collapse and they were running out of money and there was total chaos? Probably not, because news cycles move so fast, but that happened. If you think real hard, you might remember it. And as a result, you can see the dark red line of 2023. Most of last year, we were up as high several times. We were over a 3% spread. That's terrible. And that's how we got over 8% mortgage rates a few times. But you can also see in a more certain market, and what's historically way more normal, is something down here. At the beginning of 2022, we were down to 1.6% spreads. So just looking at this, 1.6 to 2.6, if the 10-year was the exact same in both of these years, or in these two versus this one, 2022 would have had a 1% lower mortgage rate, even with the 10-year being the same. So you can see how important the spreads are. A 1% higher mortgage rate for absolutely no reason. So as we start moving back into certainty, and you can see this already happening this year in the middle line, the spreads are better right now than they have been the last 2 years, which is great news, which is why you see mortgage rates as low as they are. In fact, this week we're at 2.4%, which is exactly the lowest point that we've been so far this year. We're right at the same 2.4%. But the point is, spreads have already improved way better than they were in 22 and 23. And presumably, as the economy gets more and more certain, as we get out of this fear of recession, these spreads should trend even lower, back to something below 2%. So even if the 10-year doesn't change, the Fed doesn't cut rates, nothing else changes. If just certainty comes into the market and the spreads come down, then today we would be well below 6% mortgage rates. So that's how important the spreads are. But back to the initial question of why did mortgage rates go up slightly when the Fed announced their 0.5% cut? This is because the bond market is the one actually doing the heavy lifting for mortgage rates. Priced this rate cut in a month ago. The bond market moves very fast and the Fed moves very slow. So if you're listening to the news waiting to hear what the Fed is going to do next, you're going to be a month late every time. As you saw, mortgage rates have dropped 1% over the last month. And that's literally only because they already knew this cut was coming. They saw the data, they knew the Fed was going to cut, they were betting that it was going to be a 0.5% cut, and they were right. Now, if they had been wrong and it was only a 0.25% cut, then mortgage rates would have gone up accordingly on this announcement. So why did mortgage rates go up a little bit? You could say that's just the totally normal market movement. In other words, the move was already priced in, and this was just a totally regular day of going up a little, down a little. But also, on the same day, jobless claims came in, and they were lower than expected. Then on top of that, single-family housing permits came in, and we see that housing starts are growing again. Both of these things suggest a growing economy, not a shrinking one. And remember, if you want mortgage rates to go down, then you need the economy to do worse, not better. So both of those things were signs that the economy is still strong, which means it's possible that the Fed will cut smaller or take longer to cut moving forward, keeping rates higher for longer. So that also could explain that little bit that we moved up on the announcement. Now, lastly, if you're someone who wants to see lower mortgage rates, you're counting on 3 things to happen. One is the mortgage spreads would continue to get better, down below that 2% number. That would do it. 2, you're hoping economic and labor data will get softer, which again, it did the opposite this week with jobless claims looking better and builders pulling more new housing start permits. And 3, you're looking for the Fed to get more dovish on their statements, showing a willingness to do more to help the economy stay out of a recession. Any combination of those, that's what we're going to need for lower mortgage rates, and we don't have them yet. Okay, moving on, let's start with national housing inventory. This week we had a huge increase of 11,589 more homes for sale in the country. This is the second week in a row we had a big gain like this, so this is very welcome news. However, it actually moves us down to only 37% more inventory than we had a year ago, compared to we've been at 38% more inventory for the last few weeks. So even though inventory went up, percentage-wise compared to last year, we actually went down 1%. but not a big deal. So this gets us to 725,249 homes available for sale in the country. The same week last year, we only had 528,979, so we're still much better off this year. And if you see in 2022 and 23, we had this similar slump again. We had that here, and then we continued up until October, November. So it'll be interesting to see if that repeats. If it does, I don't think it's going to get much higher than we are now, because again, rates have dropped and they should presumably continue dropping as we get further into the winter. So even though there should be less sales, right now things are actually slightly heating up, which is the total opposite. In these 2 years, mortgage rates were headed straight up at this time. This year, mortgage rates are going to be heading down. So I don't think this is going to climb as much as it did those last 2 years. And then for quick reference, at the bottom here in 2022, we only had 240,000 homes for sale in the country. The peak of last year, we had 570,000 homes. And this same week in 2015, we had about 1.199 million homes for sale. Okay, moving on to new listings. This was our biggest departure yet from the previous 2 years. As you can see, we were tracking pretty closely to 2022. Then everything got derailed here in May, and we were right in the middle of 22 and 23. And then this was when mortgage rates had their first big drop a couple weeks ago. And you can see new listings improved. And then this week, what we have is a huge jump in new listings at a time where we shouldn't be having that. And this, again, in my opinion, is just the perception. People heard the Fed cut rates 0.5%. That must mean mortgage rates are going to come down. That must mean more buyers are going to enter the market. I have to list my home right now. It's the same thing we saw back here. Here, the announcement was rates actually dropped. Here, the announcement was the Fed cut rates. This is the one that actually matters, but this is the one that more people are watching. So this week we had 70,157 new listings in the US, way better than the last 2 years. And this just shows you how much the entire market is depending on mortgage rates, even when it's just perception. So long story short, to get back to a balanced market, we need more people listing their homes like this. We need a lot more weeks like this. We're doing way better than last year. And as I say every week, and you can see here, what should be happening is we should have less and less new listings to choose from every single week. So I think this week is an anomaly just because of the announcement and the perception. I do think we're going to continue trending down like we did the previous 2 years and like we do every year. Now looking at pending sales, you can see weekly pending contracts has just been a little bit above last year, but right now we are having a bigger and bigger departure every week. You can see we're actually curving up at a time where we should be going down. This is just rates, just like everything else. Rates are going down, buyers are coming back in the market. And this year, we have about 4.5% more single family homes under contract than last year. But also keep in mind, both of these years, mortgage rates were headed straight up. Last year, they were headed straight up to 8% for the rest of the year. And this year, they'll probably stay around here for a little while, and then they may go down a little further at the end of the year. So I don't know what happens here, but what normally would happen is we would just trend down for the rest of the year. Then the last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we actually had a small drop this week, and we're down to 39.9% of homes had a price decrease this week. Last year, we got as high as 39.2. The year before, as high as 43.2. And as you can see, the last couple of years, we had this same kind of pause through September, and then the number of properties having decreases climbed up until about November. But as you can see, where we've had more price cuts the rest of the year, we're actually below 2022 now. And it's very possible we may end the year even below 2023. Because again, that's how big of a difference mortgage rates make. Speaking of mortgage rates, let's go take a look at those. Okay, so we started the week at a 6.12. After that announcement, like we talked about, we actually went up to a 6.17 and we ended at a 6.15. That's where we're starting this week. And then looking at the number of people applying for mortgages, that's the Mortgage Purchase Application Index. You can see all year we've been well below where we were in 2023. Even though we've been having more sales this year, we're having way less people applying for mortgages. So we've just had more serious buyers in the market. But you can see this is the first week in the entire year that we're actually at the same number of people applying for mortgages that we had last year. So this is a huge deal. This is our fourth week going up, and this was actually a 5% jump from last week. And I've been saying it all year. I'm going to continue to say it. There is no reason to believe that mortgage demand is going to grow significantly with rates even where they are now. Though they're close to 6%, real demand is going to come once mortgage rates get below 6% for a sustained period of time. The evidence I have of that, new construction has been offering below 6% for a while now, and they have been selling much better than the pre-owned market. So I know that there is demand below 6%. And when I say we're not going to see any real growth in demand, I'm talking about going up even above 2022. If we get below 6% rates and we hold it there, I believe we are going to be up here. Okay, before we move on to the local market data, if you're considering buying a home in Texas in 2024, a couple of things. One, if you want to make sure you don't go broke buying a house, I've made a course for you where you're going to discover your actual personal spending habits straight from your own bank account and figure out exactly how much money you personally can afford on a housing payment every month without going broke. Then we take a look at exactly how much house that would get you in today's market with today's rates. It takes into account everything all the way down to how much of a maintenance budget do you need for this house? How much could your utilities change? And everything else all the way down to your income tax bracket. This is a no-brainer for anyone wanting to have peace of mind about their home purchase. And then number two, if you're still a ways out and you just want to become a master of the home buying process so that you're fully equipped when you do step into the market and you don't have questions and you're not feeling stressed, I've made two courses for you. One is for new construction, one is for pre-owned home. They're very different. They have different contracts, different deposits, different timelines. So pick the one that best suits you. Links to all of those courses are down in the description below. Okay, now moving on to the local markets, starting with the MLS data in Dallas County. Last week, we had 589 new listings. That's 25 less than last week. 286 closings. That's 14 more than last week. Of the homes that closed, 51 were immediate sales, meaning they contracted within the first week. That's one more than last week. 292 went under contract. That's 16 more than last week. In total, there are 2,102 homes either under contract or pending. That's 21 less than last week. Now moving on to Collin County, 386 new listings, 16 more than last week. 222 closings, 15 less than last week. 32 immediate sales, 10 less than last week. 175 went under contract, 23 less than last week. In total, there are 1,827 homes either under contract or pending. That's 10 more than last week. Okay, now let's move on to the Market Action Index. If you've never seen it, it just takes into account all of this data, puts it into one easy to read graphic with a number. We mainly look at this to see, is the market looking normal or not? So this time of the year, the market should be cooling off. It is a little weirder this year, but as you can see, the Market Action Index, which anything a 30 or below is a buyer's market, so you can see we're 38, that's still a slight seller's advantage. We're slightly cooler than we were last month. You can see the trend is down overall, but we're not gonna be at a buyer's market until a 30, and we're at a 38 and moving very slowly down. Things I wanna point out, median list price actually had a jump this week. Median price of new listings as well had a big jump this week. And we actually saw this happening in Collin County, which we'll cover a week or two ago. But now we see it happening in Dallas County where prices are starting to curve up. Now, these are list prices, not the same as closed prices, so we don't get that data until next month. But the trend right now, rates are coming down, more buyers are coming in, prices are going up. But of course, this is 1 week data. We need to look for a trend, so we need to see if that's sustained. It could come right back down next week. Then median days on market remains at 56. Average increased 1, but median stayed at 56. I rely more on median for all of this data. Number of homes having price decreases, it's been pretty flat. I mean, it's been about 47 for a long time. Number of homes relisted, this number blows my mind every week. I don't see, these were homes that listed, came off the market. Around 9% of them are relisting every week. Again, this is just that perception. Well, there must be more buyers coming in the market. I need to list now. So 9% of homes that were listed are relisting. Traditionally, that's a very high number. Inventory is continuing to climb. That's great news again as we have more and more new listings. And this is the good news, is that buyer demand is coming in, there are more pending sales, and at the same time, inventory is able to grow. That's what's going to keep prices from going out of control. So Dallas County is looking pretty normal, other than we are having price increases at least this week. So let's look at Collin County. Collin County is at 37, so basically the same as where Dallas County's at. And actually this week, from a 0.77 to a 0.70. So almost no change. Now you'll notice in Collin County a few weeks ago on new listings, we had a huge $115,000 jump up. Of course, that's why we look for trends, because it came halfway down the next week to 550, and it basically stayed at 550 this week. So you would say over the last 4 weeks, the price has been trending up from where it was. You can see it was trending down for a while. So both Dallas and Collin County prices could be trending up. You can see the trend a little better in the median list price where it didn't have this exaggerated move up. You can see it was down and it's just trending up slowly. Their average days on market remained the same as last week. Their median days are still lower at only 49, lower than Dallas County. And their inventory has been just flat. Very, very flat, not really climbing. And then of course their market action index trending down, not trending up. That part's looking normal. The only thing not looking normal here is prices seem to be starting to climb again, but slowly. All right, moving on, we just look at pending sales, and Dallas County has more pending sales than we had either 22 or 23, significantly more than 23. Let me just show you that. Look at that difference. Dallas County is having way more sales than it did last year, and even more than it did in 2022. That's pretty wild to see. Then looking at Collin County, let's just look at 23, significantly more. Now this is a combination of we're having a better year this year than last year, as well as Collin County is the #2 fastest growing market in the country. So yeah, Collin County is just growing big time. That's why they have so many more sales. Now we're moving on to the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin County. This is ranked using that market action index number we just discussed for all these different cities. Starting with the hottest city. The absolute hottest for the first time ever becomes Ferris, Texas. It heats up one spot to take the #1 spot, knocking Carrollton off, who's been there for several months. But you can see Carrollton is cooling off quickly the last few weeks. Still a 47.2, very hot market, but you can see that line versus this one holding much more steady in Ferris. But Carrollton cools off one spot. Duncanville and Sachse remain. Lancaster heats up one. Louisville cools off one. Garland heats up one. Irving remains. Grand Prairie cools off two. And Plano remains at the #10 spot. Then we like to zoom into the specific zip codes. The absolute hottest is Carrollton 75007, then Hutchins 75141, Dallas 75244, Carrollton 75010, Allen 75013, Irving 75061, Duncanville 75137, Ferris 75125, Garland 75044, and Garland 75041. So if you own a home in any of these zip codes, then you are able to get top dollar. Congratulations. Now moving on, same thing but the coolest cities and zip codes. And remember, anything below is a buyer's market. So anything below Whitewright, these are all buyer's markets right now. So the absolute coolest remains Leonard, Texas at a 26.6. Sunnyvale cooled off 3 this week. Blue Ridge remains at #3. Van Alstyne heats up 2, Whitewright heats up 1, Anna and Prosper remain, Salina cools off 2, Rockwall remains at #9, and then Lavon jumps onto the list as the hottest city on the coolest cities list, and then Farmersville, which was #8 last week, heated up entirely off the list. Then looking at the coolest zip codes, Leonard 75452 is the absolute coolest, followed by Sunnyvale 75182, Blue Ridge 75424, Dallas 75204, Van Alstyne 75495, Whitewright 75491, Rockwall 75032, Dallas 75220, Dallas 75212, and Anna 75409. That's it for this week. Remember, if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.